Hi, I'm Tom Stevenson and welcome to Construction Business Management. In this course, we are looking at how to start and run a construction business and how to effectively manage it. In today's video, we're going to be looking at return on investment. What does it mean to be in the construction industry? What does return on investment mean to us? How is it calculated? We'll go through a house example if you're developing a house and some of the advantages of leveraging that work, some of the disadvantages of leveraging as well, and why do people get into business in the first place. And a big part is when you compare return on investment to what else you could do with your money. And a lot of people bet on themselves. And when you bet on yourselves, if you're very good at what you do, then you have increased the likelihood of being successful in this area. But also, I think it's important to understand risks and understand the role that luck plays into things of this nature. So we're going to look at a bunch of things here. And if you haven't been following the series, I would ask you to check out, I've got in the description a listing of previous videos. I would say click subscribe, and under the playlist Construction Business Management, you'll see all the videos in this particular course listed. So you can always go back because we've done a number of ones on financial statements that have built up to this particular video. All right, let's get started. So return on investment, it really can be defined as being a performance measurement that evaluates the efficiency of an investment. It's really looking at, well, if I put so much capital into this business, what am I getting in return for it? And that is a very useful tool because you can then measure, well, what other opportunities would I have had instead of doing this? You know, I could have put it in the bank, I could have done this other type of business, etc. And you can sort of make evaluations that give you a good idea where you should go with things. And so return on investment is very useful for that purpose, and it's different than profit. So it's really that investment return that it provides as a percentage over time, and it's given as a percentage. And really it's based on, when we think about it, the formula below, the gain from my investment minus my investment over what my investment was. So it'll give you a percentage of what this investment, so if you had $500,000, what this investment would have returned. And you can put it over a time frame, like a year. You know, what would I have gotten over the year doing this with this money, and what would I have gotten over a year of doing something else with the money? And usually when we talk about finance, you know, I remember when I was doing my MBA and we were doing portfolio analysis and we were doing different investment equations, one of the things that we always talked about was the risk-free rate. And the risk-free rate is, what could I put my money into that I'd be sure that I get my money back? What kind of rate of return for doing that? Now, if the risk-free rate is pretty high, then you've really got to ask yourself, well, if the risk-free rate is at 4% and this project is only going to return 4%, why would I take these risks that's involved in construction and development if I can just put it into something that is risk-free? So what would be risk-free? Well, we usually in finance looked at what they called the risk-free rate would be something like a 90-day T-bill, treasury bill. So in the United States, a 90-day treasury bill, or Bank of Canada, a T-bill, would be what interest rate does it provide? And it's risk-free because, you know, in this world, there's nothing that's 100% risk-free. But in North America, the way those Canada, the United States are right now, you know, very, very, very unlikely, you know, 0.0000001% chance of them either going bankrupt in the next 90 days. At a certain point, if you think about countries, well, maybe around 2012, 2011, Greece, you probably would be looking at their T-bills or their bonds or whatever they were issuing at that time, risk-free, not that risk-free, right? Not that risk-free, even at 90 days, because they were teetering. But these are some of the things that you look at. So that's a pretty valuable comparison. Another one you could look at is, your high interest savings account in a bank. And like in Canada, it's CDIC protected. In the U.S., they're protected as well, up to a certain amount, like 100,000 or 250,000, depending on which country. What does it give you as far as an interest rate? Well, if you actually look at it right now, it's very, very little. So right now it's about 0.1 of 1%. So if you put in a $1,000 or $100, then you're going to get like $1 in return, right? That's actually less than that. You're going to get like that's 1%. So that would be 1%. It's 0.1% the interest rate right now. So you get like 10 cents, next to nothing, right? So yeah, risk-free, I could put my money in that. I could put it into this bank account, high interest savings bank account. And at the end of the year, for sure, I'm going to get that 10 cents on the $100. But it's not really valuable because, to be honest, it's actually losing value because inflation is running at a higher rate than that. Inflation is currently running at close to 2%. So really, the buying power of that money after a year, it's going to be worth less than what it would have been, versus another project, let's say. Now, what's the project that we're thinking of doing in construction, right? What's it going to potentially give us as a return on investment? So that's our discussion today. What kind of return on investment will that provide for us? And that's really sort of the key player in that. What kind of return on investment is that going to return? We can compare to the 0.1 or what this development is going to return. But the development is not going to be risk-free. So then we have to look at, well, how risky is this? If it's really, really risky and we might lose our capital that we're investing in it, well, we might have been better to have placed it in that risk-free rate, or some other thing like the stock market might perform better. We have to decide, given a basket of options, what's our best investment. So we can think about that and compare it to other potential projects. It might just not be one project. We might have different alternative projects, and we can evaluate them on that basis. Leverage is where we use other people's money to leverage that return. We can get more back if we borrow to build this development project, and it actually comes through successfly for us. It'll give us a multiple of what the rate of return would have been. So that's very thought-provoking there. However, when we leverage, we also take on more risk because we don't have to be off too far in our calculations before we've wiped out our investment. Because it's leveraging it. That means that we're using somebody else's money. So their money doesn't go first, our money goes first. And we're leveraging it to do a bigger amount of something, build multiple houses instead of one, as an example. So there's definitely risk there. The other point that I want to make is luck. Business owners often forget the role that luck plays. You can be really good at playing cards, right? You could be really good at poker, but there is a small element of luck involved in that because you're playing with probabilities. If you've got a hand that has a 90% probability of success, it also means 10 times out of 100, it's going to lose. 90 times out of 100, it's going to win, but 10 times out of 100, it's going to lose. Well, if this is the project you took that had a 90% chance of success, you might be just the timing. You're in the middle of it. Basically the markets fall, real estate prices drop significantly, and you could be wiped out. So that's another thing that plays. And I know a lot of developers, they get into a marketplace, they start their business, and they go 10 years really well, and they think that they're this fantastic builder developer, but they're not all that good. They kind of hit the market really at a good time, and these houses they've been building, they didn't exactly build them that productively. They had a lot of rework involved in it. But because the market kept going up, during that time period, even if it took them longer, whatever the extra costs in financing was covered because it was now more valuable. So actually being wasteful kind of worked in their favor. But as soon as the markets tank and they're not very productive and they have a lot of efficiency issues and waste issues and productivity issues and they are over leveraged, they get caught and they lose everything. So it's really about understanding what risk is and what luck is. And if you want to think about it, luck is kind of the opposite of risk. And that plays a role. If you want to kind of get into that sort of psychology a little bit, there's a really excellent book. It's called Thinking in Bets by Annie Duke. And it really, she's a world champion poker player, and it really sort of shows you how the decision-making model plays into risk and luck and what formulates a good decision, and understanding when you made good decisions as opposed to just thinking because you had a good outcome you made a good decision, which is not always the case. Sometimes you have a good outcome when you made bad decisions, builds your confidence, unfortunately, and then exposes you in certain situations. But let's get into the case. So we have a developer purchases a property for $100,000. Now, I'm using a very low number in this. In my spreadsheet later, I'll use higher numbers. Let's assume you're maybe in central Canada or the Midwest, and it's in a kind of a rural location, so the land is fairly low in value. If you're in a big city, you know, you could add zeros to that, right? It might be $1 million that the land is to purchase. And you're building a house 3,000 square feet, and again, your house costs are 150 per square foot. Depending if you're in an urban market, they might be double that. And they are then able to construct and sell the newly built house for $650,000. So that's just taking your, you've got your 3,000 square feet and you're building the house. So that'd be $450,000. And you've got $100,000 for land. That's $550,000. And you're able to sell the house, sell it for $650,000 within 1 year of purchasing. I'm trying to make it a nice even year because that makes it easier to see the percentage. So the developer invested $100,000 of their own capital in this project and financed the rest, right? All costs, including financing and price per square foot. So what is the developer's return on investment for the project as a percentage? $100,000 purchase of the land, $1.50 times 3,000, that's $450,000 cost to build it, right? We add the land value plus the build value. And again, you can plug in different numbers here, whatever is in your jurisdiction. That would be $550,000. Sale price, $650 minus $550 equals, that's your gain from the investment. So you take your gain from the investment and so you've got your gain from the investment and your investment. So you divide it by the investment and that gives you 1. So you've got a return on investment then of 1 or 100%. So from your $100,000 that you invested, you got $100,000 back. So ROI is different than profit on sales. Profit is $100,000, right? So $100,000 on sales, we would say that we made 15.38% profit. But our return on investment is we got $100,000 back for that $100,000 we put in a year. You are not going to get anywhere near that on any kind of risk-free rate, right? I said like 0.1 of 1%. You got a very, very large amount of money back in this example. Now, there are other things that could, of course, go wrong with this, right? You thought you would be able to sell it for $650. The market changes, and if the market changes, maybe you sell it for $450. Well, you've lost your $100,000, and you have the banks chasing you for the difference, right? So that has a certain amount of risk involved with it. Now, there's also the advantage of time, right? So if we're borrowing money like that, and we're also looking at time, this took us a year to build this project, right? So we said that this project here it took a year to, here it is, 1 year of purchasing the house, right? Now, what if we were able to use that money quicker? What if we were able to build the house faster, right? So if we take the same example, but in this scenario, the house, well, actually in this scenario, the house is taken longer to build, all right? So longer to build instead of shorter to build. So we'll do this one first. The project ran behind schedule, and as a result, there were a number of cost overruns. So things didn't go exactly as planned, including the extra cost of financing. Well, in the case of a development, if it takes longer, you have to pay those financing costs. So whatever interest rate you've got on that, and by the way, it won't be like a mortgage rate. It's going to be a higher rate because you haven't got the house built. So whoever's lending you money is, because they're taking on extra risk, should be charging a higher rate on it for that period of time. So you're taking a longer period of time. The extra cost of financing, you got to pay the property taxes, inflationary costs totaling an extra $40,000. Also, the real estate market softened somewhat, depressing the sale price by $30,000 to $620,000. So if we run through that scenario, we've got $100,000 purchase price of the land. We've got all the other things we had before, plus the extra costs, right? So that's adding to our cost to build to $490. So now we're up to $590. The sale price dropped. It was $620. Well, we're still actually ahead. So if we take that 30,000 and we divide it by our 100,000, our initial investment, if you will, which is on the denominator, and so this is essentially what we returned, and this is the denominator. We're looking at a 30% return on investment. Still not bad. Still not bad, even with all of those problems. The nice thing about doing this sort of thing, you can set it up in a spreadsheet, and you can do a variety of different sensitivity analysis to see how it's impacted. What if it took longer? What if the market softened? So what kind of parameters before we're into trouble occur? Gives you something to think about. And then you can also look at, well, what's the probability of this happening? You can sort of get a good sense of the types of risk that you may be taking. So the changes to the above example have drastically reduced from 100 to 30%. And the profit on sale has dropped drastically from 4.3 to 4.8. Definitely like the first scenario better. So time is an issue. And maybe if we hadn't taken so much time, the market might not have softened. The longer you were exposed to that loan, the more opportunity there is for that to occur. Now, as I said before, you could have been lucky and the market went up in value and you taking longer could have been an advantage. But these are things you need to think about if you're going to do developments. And it should be as something that you think about if you're going to be investing in a business too. You know, what kind of return? I've got my life savings. What should I be doing with this money? And what are the potential risks that are involved? And what potential return on investment? So a large part of the decrease, as I said, is due to the fact that the project took twice as long to complete than originally planned. Actually, I don't think it was twice as long. Did I say 18 months? I thought I said 18 months. There it is. So it's not twice as long, right? So this increased the carrying costs of the property, and inflation also started to have an impact on project costs. Good to know what's going on, and better to know it ahead of time. So let's try another example. So in this example, we're going to use 1A again, the first one in this scenario, but this time we're going to build the house in 6 months instead of 1 year. And not only that, with that money that we get from the first house, we're going to be using that same money. Once we sell it, we get that money, we're going to flip it over and use it in the second house. So we're talking about a 1 year period. And instead of in 1 year building one house, we're going to build two houses using the same money. And so the developer purchases the property for $100,000. They build two new 3,000 square foot houses. So you're assuming they bought the property of one, and then 6 months later they bought the property of the other. It's kind of very clean, but probably not as clean as in reality. But I want you to picture what kind of impact that has on your return on investment, right? So we 6 months of the year, investment, reinvested in the second house, complete in the second 6 months. Both houses are built at a cost of the 150 that we mentioned before, and they sell both of them for 650,000, and that you're invested only that 100,000. So you built two, but you didn't end up having to have 200,000. You kept using your own money that twice. All right, so what does that return on investment look like? So we do these two scenarios side by side. We run them out. And of course, the numbers are doubled. Total cost of both houses, sale price of both houses. And we got sale price of house one plus sale price of house two. That gives us minus our costs, 1,100,000. So that gives us 200,000, so of what it costs. So that's looking at a $200,000 profit on 1,100,000 on the 1,300,000 in sales. And so if we want to look at our return on investment, we take our 200,000 and divide it by our initial investment, which is the 100,000, which gives us 200% return on investment. Wow, that's a big return on investment. We just doubled our money in that year. So you're not going to find a stock market where if you bought, say, an index fund for the Dow Jones, you're not going to be getting 200% return on that investment in 1 year. In the best of years, they have some pretty good years, 40, 50% returns, but you're not going to be getting 200. That's pretty high. And the other thing with this is under your control, your business, you're running it. So if you have a high level of self-efficacy, a high level of confidence, and you have a high level of experience, that's why a lot of entrepreneurs become entrepreneurs. They are excited about that premise and that possibility. And there's a lot then incentive for you to be very efficient at scheduling the work and putting it together and being very productive in putting it together. There's strong incentives for that. When I used to do some consulting with huge home builder and their CFO, I had some meetings with, and they explained to me the advantage when they built thousands of homes a year, the advantage of shortening the turnover time, the build time, what that did to their ROI. It puts it through the roof. When you consider thousands of homes, even shortening it by 10 days. So if you're taking 140 days to build a house, if you build it in 130 days, but you're doing thousands of them, it puts your ROI through the roof. So it's a huge advantage time-wise to reinvest, because they basically, when they close one house, the money from that house goes into the next houses, right? It really dramatically increases your return on that investment. So being able to build two instead of one has a huge impact. If you're not clear on what I mean there, you can sort of see it on a schedule. This was the one that was taking a lot longer. This is basically doing one house in the year, and then this is doing two houses in the year. So comparing this to that, you double your ROI. And of course, this went way down when you have other things that are outside your plan. So I did mention that you could use a spreadsheet to develop this. And so with the spreadsheet in mind, you can sort of take an Excel, and maybe I'll just flip it to Excel for now, just that you can actually see it wherever it went. There it is. Okay, so in Excel, you can see it, and we have this home development example. So you put in the land cost, you put in the price per square foot to build it, you put in the square footage of the house, the cost to build plus land value, builder investment. So what are you putting into it? Amount borrowed, sale price, and profit, right? So this gives you profit. And profit as a percentage of sales, that would just take this and divide it by that. As a percentage of sales, so you take B equals B11 divided by B10. And if you look at return on investment, then it's basically taking, in this case, you just round those numbers. So you've got basically return on investment B10, which is the sale price, and you're subtracting B7, which is the build plus land price, right? So that's giving you that difference, which is the 200,000. And then over at the bottom here, then you've got your builder investment. And what I've done is at the top, homes built per year. So I built one home per year. So that's giving me a 40% return on investment. This is just rounding these numbers here. So 40%. And I could try it different ways. I could try the same scenario, in this case, where I've got 2 homes I'm building a year. So in this case, I'm going to be able to do that scenario. I've just used different numbers, much higher numbers, more likely in a big urban center. Think Toronto as an example would be more realistic here. And I plugged in these numbers. And so then I can see what my return on investment is looking like here. If I build 1.5 houses, because maybe 2 is a little bit too aggressive. You've also got to be careful if I go too fast. Maybe I've got quality issue, that sort of thing. So that might be maybe being too aggressive. What if it was 1.5? What if it was 1.75? And then you can sort of see the difference if I do 1 or I do 1.5 houses in a year. So in other words, I'm doing 3 houses in 2 years. What happens if it took me a lot longer and I only get half a house built in a year? Then that would be 20% return on investment. So I got to decide, well, is a 20% return on my investment worth risking $500,000 for? Maybe not. That's not a lot when you're risking $500,000. Maybe this makes better sense. You know, you have to look and weigh those aspects. If you're not even thinking about that, I think that's problematic when you run a business, especially when it's not difficult to set up a spreadsheet in this way, right? So I'm just putting these formulas that you can see them in case you want to create your own, particularly here and here, right? You can always freeze the video and take a closer look at it. But that's what you can do. Now, going back here, you've got to foundationally know that you can build this for $300 a square foot. So that brings in the whole area of being able to estimate and have an understanding of costs, having an understanding of your finance costs, your overhead costs. All of those things need to be understood, right? Going back to previous financial statement discussions and also going into the trade and the aspect of knowing how to estimate and knowing how to put the project together, knowing how to schedule the project for time frames and what's possible and what's not possible. So there's a lot of feeders into this. We're talking business management in this course. So a lot of the base level stuff has to feed into that. So you have to have clarity on a macro level so you can build on the micro level, so to speak. So that's bringing us back here where I have this put in here for that purpose. So just getting back to leverage, it's an investment strategy of using borrowed money to increase the potential return on investment. And you could clearly see you're borrowing a fair amount of money, and it definitely does increase your return on that investment. If you are, and you could adjust any of these numbers, say, okay, what if the bank requires me to put in an equal amount? So then I'm going to have to up this number, right? Probably have to have it at 850 instead of 500. What do the numbers look like? You have to look at it from what's possible and what's realistic. So when we think about measuring too a company's viability, we talked about ratios in a previous video as well. The debt to equity ratio, or if you're taking from your balance sheet, total liabilities over shareholders' equity, looking at what is that? Like, are you too leveraged? Do you have too much debt compared to the value in the business, like your assets that you've got currently in the business, your equity ratio that's in the business that is there? If this is overly leveraged, then you're going to have harder time actually getting these kind of loans. So that's another thing that comes into being able to leverage that banks actually look at. Risk increases with high debt to equity. So for sure, you got a lot more debt. Doesn't take much for you to lose on that. Like if you were able to only borrow, put in 100,000 of your own money on these kind of numbers, this number return on investment would go up hugely, right? But nobody's going to give you that much leverage on that they're going to be taking that much risk, because you don't, the 500 to the 1,400,000. If you've only got 100,000 in this, and this is at 1,700,000, it's going to dramatically change these numbers to your favor. The problem is nobody's going to let you leverage it that much. They may not let you leverage it this much, right? So those are other considerations that come in as well. And you are taking more risk when you leverage that way. Luck often plays a role too, as I mentioned, right? So just reiterating that, just because you've had good outcomes for a few projects doesn't mean you're always going to have those good outcomes. So you got to look at the downside. So that's the advantage of setting up a spreadsheet and sort of running the numbers and taking a look at that. And you can look at this in a lot of ways in your projections, for your business. How much money did I put into this business, and what am I projecting? It doesn't have to be a development. What am I projecting that after a year we're going to get out of the business? Like what basically is our return on that investment? And then you're looking at it, so I'm betting on me, and with this money we're putting in, we feel confident we can get to here, and we're getting 30% return on investment. That might make sense to you, right? It might make sense to you, but it might not. Am I betting the farm? Are we going to be out on the street? So from a business perspective and starting a business and growing a business, it's good to think in these terms and think about things in this way. So some reflective questions you might want to ask yourself. How does knowing the return on investment for each construction project help owners compare different projects? What is the advantage of leveraging capital? What is the disadvantage of leveraging capital? And I strongly advise you look at both. I'm not here to sell you that leverage is a fantastic thing, but it can definitely be a tool that allows you to do certain things and to think about it in those ways. And it's good to understand what is the return on investment potential for what I'm doing with this money we saved up that we're actually putting to start and grow this business. And does this make sense for us? What are we getting ourselves into? Hopefully it's going to be a very positive thing overall. It's what drives a lot of entrepreneurs, small business owners, construction people that have started with very little and grown a lot in their businesses. So I'm Tom Stevenson. I'm hoping this is giving you some fuel for thought. Just remember, there's risks that's involved with this, and what's the type of risk that you're willing to take. This example with development tends to be more risky than, say, doing renovations for somebody, because you're not putting that much money into that's getting into more managing your cash flow effectively and just making sure you're covering your overhead and profit amounts. So there's different levels, but because of the risk, it should provide bigger rewards, and this definitely does in those cases where it's leveraged. So I'm Tom Stevenson, wishing you a wonderful day, and just reminding you to click subscribe. You can look under the playlist for construction business management to see the rest of the videos in this series. And if you click notifications, you'll be updated for future videos. Okay, bye for now. Have a great day.